Well, hello everyone and welcome. This is Cynthia Tomaine with Interactive Brokers, and thank you for joining our webinar today, being brought to us by FS Insight, a Fundstrat company. Now, I'm very pleased to introduce Thomas Lee, who is a CFA and head of research for Fundstrat. Thomas is a well-regarded strategist focusing on both equity markets as well as emerging technologies such as digital assets. Thomas has over 25 years of experience in macro markets and equity research. Prior to co-founding the independent strategy research boutique, Fundstrat Global Advisors, Thomas served as chief equity strategist of J.P. Morgan and Chase Company from 1999 to 2014. And prior to that, he was also a well-regarded telecommunications equity research analyst. Now, Thomas is known for his data-driven approach, analysis, not opinions, and clients do view his work as both contrarian and highly differentiated. So with that, if you would all please join me in welcoming Thomas this afternoon. Thomas, I'm going to go ahead and pass you those keyboard controls. Let's go ahead and get underway here this afternoon. Thanks for joining us, Thomas.
Great. Cynthia, thank you for the introduction. And I've got a slideshow here. So over the next 45 minutes or so, I wanted to cover three topics. The first is I want to talk about why we think the U.S. has been decoupling from all this bad news, this bad macro news. And I think it's grounded in some very explainable factors. The second thing I want to talk about is really give you a long-term view about where we see equity markets going and what are the key drivers for the S&P and potentially what levels we should see in 10 years. And I think that this is really probably the most important part because for those who aren't familiar with our work, our institutional clients really focus on that sort of second dynamic that, we use evidence-based work to really explain where we see markets going to. And then the third part is to give you some recommended strategies. And then this is really put through our FS Insights, both as thematic ideas as well as stock lists. So I'll walk you through some of the key investment strategies we see being successful over the next few years. So I'm going to start advancing the slides here. And Cynthia, just FYI, I think it's not advancing.
All right. Let me know. I'll start adjusting the slides.
Yeah, okay.
Just
so
let
if we
me know
can
when you
turn
want
to slide
me to.
3. Oh, I guess slide 4 because we're, there, right there. Perfect. Okay. So here are some of the sections I'm going to cover. One is, I think the world is kind of scary at the moment, so I don't want to be too dismissive of the problems in the world. And I think three things really stand out there. But in the same breath, I'm going to say that in the face of all this scariness, the equity markets are really ready to have a big bounce into the end of the year. The second is, again, I mentioned this, we think the U.S. is decoupling from the rest of the world for structural reasons. So these are sustainable factors. I don't think the stock market is giving us a false message. I think its performance this year is really telling us something very decisive. And then there's the longer term outlook, which is, look, I think U.S. competitiveness is going to strengthen because of labor shortages around the world. And I think demographics are a huge factor in the U.S. that are really going to create a very positive runway. And so we have some strategies to take advantage of that. So let's turn to slide 4 and talk about what's scary about the world. I think that there's a lot of things that are terrifying. In fact, if I had to say, list the bear case for equities, it's almost 10 items long, okay? It's everything from the economy's late cycle. We got inverted curves, negative rates. We've got some people very fearful of the current administration. Credibility of the Fed's being questioned. We have PMIs crashing. And it's important to know that this is what looks like an overwhelming bear case for stocks. But keep in mind, if in fact this overwhelming bear case was true, the S&P 500 should have broken down badly. And I think there are three things that particularly scare people. So if we turn to page 5, the first is that PMIs around the world are very weak. So this is a list of PMIs by month with the various countries, and wherever it's red, the PMIs are below 50. And as you can see, as we've moved through 2019, the pervasiveness of red plots or PMIs below 50 has been growing. So I think that this is one of those structural issues that we have to be mindful of for the bear case. Similarly, if you turn to slide 6, there's been a plague of negative interest rates around the world. The number of bonds with a negative interest rate today that are government bonds has now hit 27%. And this is a slide from Deutsche Bank, which is nearly an all-time high. And the last time it was this high was actually in 2016, which was around some macro issues at that point, but it was a global economic slowdown and election cycle. Now, if you turn to slide 7, one of the things to keep in mind,
Tom, would you actually try moving the slides? I think you have control now.
Okay, I'm going to give it a try here.
There you go.
Okay, great. So slide 7 shows you that one of the consequences of negative rates has been a pretty dramatic rise in the price of a government bond. So what you have to keep in mind is when interest rates, as they approach 0, or actually, and as they go negative, the coupon paid on those bonds is not changing. So to adjust for the interest rate, you have to change the price of the bond. So as we're moving towards more negative interest rates, it's caused a massive, massive price gain for bonds. So for instance, if you look at Japan, their 40-year bond just in the past 12 months is up 30%. In Germany, the 60-year bond is up 60%. And in the US, the 30-year bond is up over 32% this year. So these are not .com price charts. These are the price of long-term government bonds. And so I think one of the things you have to keep in mind is that as interest rates have gone negative, the long-term bond has become a big momentum trade for hedge funds, which is causing more interest rates to go negative, because as these prices go up even more, it's causing the implied yield to worst or yield to call to actually get even more negative. So one thing to keep in mind is there's something very scary when we see this rise of negative interest rates, but there's people profiting from that rise of negative rates. And in fact, I think it's causing negative rates to go even lower. Now, I'm going to skip a few slides to slide 10 because I want to talk about, I think, the third thing that really scared, the third most scary thing about the world right now, which is the U.S. yield curve. And what this chart shows is the level of interest rates on the blue line for the different maturities of the U.S. Treasury curve. So everything from the 1 month all the way to the 30-year bond. And as you can see, it's kind of a swoosh shape, Nike swoosh shaped curve. You know, that the 1 month is at roughly 2.05%. The 5-year is down at 1.5%, and the 30-year bond is at 2.1%. Okay, so we've got a very unusual curve because it's both inverted and normal shaped. But more importantly, if you look at that red horizontal line at the top, that's the Fed funds rate today, 2 to 2.25%. Every interest rate today in the U.S. Treasury curve is below the Fed funds. Now, that's a very unusual situation. I think it's clearly an exception when the Fed funds rate, that's the rate set by the Federal Reserve, is above the interest rate of all the bonds issued by the U.S. government. Okay, and to me, this really screams policy error. So as I've marked on this chart here, the Fed is overly tight. The bond market is saying that in order to create a normal yield curve and what you and I would perceive to be a functioning normal bond market, the Fed has to cut the Fed funds rate to roughly 1.25 to 1.5%, or a 75 basis point rate cut. So I think at the moment we have to keep in mind that the Fed is overly tight today, and um, and that's a policy error. So I think that that is something that's going to be addressed over the coming months with the Fed. So to me, those are the three things that are scary. Okay, and you might say, well, then if these are scary, shouldn't we be really worried about equities? So I'm going to turn to slide 11 and tell you, yes, we should be worried, but you have to keep in mind is there's things that you should worry about because no one's worried about it. But if everybody's worried about something, it's probably telling you that it's already priced into the market. And to me, I think that the fears of negative rates, weak PMIs, and the Fed with the inverted yield curve have caused a panic about a recession. And in fact, how do we know that there's already been a panic about a recession? Well, let's take a look at something as simple as Google search trends. So the top line there is Google search trends for the word inverted yield curve, okay? And if you look at the right, the search for inverted yield curves has gone parabolic since in the past month, but it is not only gone parabolic, but if you look at the last time the yield curve inverted, which was 2005, the search volume or intensity is 4 times the level, all things considered, okay? And then look at the word recession below. You can see that the search for the word recession has gone parabolic and now matches where it was in January 2008, okay? But here's the thing. The yield curve had inverted in 2005, December, and searches surged, but it wasn't for another 2 years before people were searching for the word recession, which was January 2008. Well, today, those have been contemporaneous or simultaneous searches. So I think the world has actually gotten recession mania. And again, I think that's why stocks have really overly discounted all the downsides that we've talked about. Okay, so what are some reasons why we think stocks can bounce? I'm going to just highlight these really quickly because I don't think that these are essential to our sort of view about U.S. equities decoupling, but they do tie into why we think stocks are ready for a bounce. So foremost, the Fed's been cutting interest rates. And here's the thing. You have to remember when the Fed starts to cut rates, it doesn't necessarily help stock prices. It only helps stock prices if the Fed is actually cutting rates while in an expansion. So doing what you and I would view as a mid-cycle adjustment. But if the Fed's cutting rates during a recession, well, there's nothing you can do to prevent a recession. So once you're in a recession and the Fed's starting to cut, well, you have to let the recession dynamics take place. And so this is what this chart shows on slide 12, that if you look at the last 50 years, the Fed, from the time the Fed first cut, but if you were already in a recession, this is the outcome on the left side. So you can see once the Fed starts to cut, but the economy's already slipped into recession, the probability of stocks going up over the next 3, 6, and 9 months is only 20%. So stocks basically don't really rise when the Fed's cutting and you're already in a contraction. But take a look at the right. There have been 6 times where the Fed started to cut, but you were still in mid-cycle expansion. And as you can see, 100% of the time, stocks were higher 3 months, 6 months, and 9 months later. Now, slide 13 makes this a little more clear because you could say, well, what's an easier way to look at this is let's look at LEIs, or leading economic indicators. And as you can see on the left, the LEIs in the U.S. are still positive year over year, so we know we're a positive trend. But as you can see, this is the 6-month return of equities whenever the Fed makes its first cut and the LEIs are positive. And as you can see, in each instance, stock market's positive, the average gains 14%, and this implies that the S&P, which is the bottom half of that left side, the S&P will be around 3,400 by the spring of next year. So if you ask me, is it bullish that the Fed's cutting and we think people are overly focused on recession? 100% yes. I think stocks are ready for not just a bounce to old highs, but to really blast to new highs. Now, on slide 14, slide 14, slide 14. Let me try to advance this. Here we go. There's another thing that's been happening. See, the VIX is a really good measure of fear, but I think a better measure of fear is actually the VIX Futures Market. So the VIX Futures Market measures what people think the VIX will be at various points of the future. Well, this is actually quite interesting because normally people think that time means the VIX curve or the futures market should have, a rising VIX over time, so that, 1 month out the VIX is a certain level, but 4 months out the VIX should even be higher just because of time value money. But there's instances where people become so fearful that in the short term, okay, the VIX is higher. So it's causing what you call an inverted VIX term structure. Okay, so that means the 1 month VIX is actually priced above the 4 month VIX because someone thinks something in the near term is going to have, cause a volatility spike. And since 2009, this has actually only happened 7 times, which are marked here on this chart. So you can see that of those 7 times, I've marked on the bottom here how many days before the stock market actually bottomed from the time you get an inverted VIX term structure. Well, you can see there were 2 times, which was in 2016 and in October 2018, where the market didn't bottom. It took somewhere from 18 trading days to 34 trading days. So it was actually an extended period of downturn. But outside of those instances, in fact, 5 of those times, the stock market bottomed within the week. We got an inverted term structure in August, and again, we think that that's a big tactical signal because, as you can see at the top, once you get an inverted VIX term structure, because that shows a lot of panic, the average 6-month gain for markets is 9%. That again puts the S&P into the 3,200, 3,300 by the spring. So again, now you have 2 reasons why we think in the next 6 months we see double-digit gains. And the third reason we think we're going to see double-digit gains before the end of the year, but by March, is, and I'll just highlight this really quickly. The stock market had a panic. We had a 3% decline in one day. Now, since 2009, that's happened 24 times. Okay, but as you can see, what is the 6-month return for the stock market whenever you've had a 3% one-day decline? Well, the average gain is 15%, and 96% of the instances are positive. Again, it's a huge, huge buy signal. It's telling us that stocks do really well after a panic. And in fact, the final measure of panic is the AAI Bulls Less Bears. Okay, and this is one of our favorite retail surveys. And as you can see, we had a bears, percentage of bulls, less percentage of bears, hit minus 26%. Okay, and since 1987, whenever this has happened, okay, that's the middle of the chart, the stock market gains 9% on average over the next 6 months with a win ratio of 73%. So automatically, out of the 1,641 weeks, there have only been 56 times, so it's really rare that we've had a minus 26% reading on the AAII. But more importantly, the PMIs also happen to be over 50 at the time that this took place. And as you can see, the average gain is 10%. So again, even looking at a retail sentiment survey, it's telling us the stock market's probably up double digits by March. So we're pretty bullish. And again, this is like saying, hey, look, the S&P 500 seems like it's going to decouple. And I do think that is correct. So let's turn to page 18. Why should the S&P be decoupling? Well, keep in mind, it's the consensus view right now, and the consensus belief is that the U.S. is slipping into a recession. But I think that in general, sentiment has been more bearish on average than any time since 2009 because of the financial crisis. And I think it's caused investors to become, by default, somewhat skeptical. But here's something more important. There are a lot of constituents that benefit if the U.S. does indeed slip into a recession. So I think part of the reason we're seeing this chorus and drumbeat towards a U.S. recession is because there's actually quite a few parties that benefit if the U.S. actually has a recession. The first is obvious, and I'm not going to spend too much time because I don't think it's that they want the country to fall, but short sellers benefit if we slip into a recession because stocks will fall. The second is Democratic candidates. 2020 elections are around the corner. The economy is one of the biggest swing factors, and if the U.S. enters recession, no sitting president has ever been successfully reelected. So I think anybody who is in the Democratic Party in general is probably hoping for a recession. For those who do not like the current president, they also are cheering for a recession because, of course, it's a reflection of his presidency. Bondholders want a recession. Why do bondholders want a recession? Well, if you own a long-term government bond and we slip into a recession and rates fall, massive upside price to bonds. China wants a recession in the U.S. because it's going to force Trump to capitulate. I think in some ways the media is also somewhat cheering for a recession, mainly because of those in the media that don't like the current president. This would again be a repudiation of his presidency. I think Europe is essentially cheering for a recession because of Schadenfreude. Private equity has $2 trillion of dry powder. It's the largest war chest ever raised by the private equity industry, and that money will be put to work in the next recession. So they're waiting for a recession. And finally, not that conclusively, and I think there's been suggestions by former Federal Reserve policy members that the Fed would benefit from a recession. So I think in general, there's there's a lot of beneficiaries of recession. I think that's why people tend to think we're in a recession. But if you look at slide 19, this just does not look like a stock market that believes there's a recession. The S&P is up 19% year to date. This chart's a little outdated. 19% year to date. To me, if I was doing my amateur technician eyes, this looks like a consolidation before another big up move. So to me, the stock market's telling us something. And indeed it is, because the stock market is the Timex market. It's taking a licking and keeps on ticking. So first, if I turn to page 24 or 22, I think the first thing that the stock market is telling us is that it's decoupling. So this is a price chart of the S&P versus the MSCI World Index since 1970. And as I've marked here, since 2005, the U.S. has been steadily and continuously outperforming the rest of the world. That's about 6,900 basis points of relative outperformance. That's monstrous since 2005. And just even year to date, it's 450 basis points. So the outperformance has continued even this year. And in fact, the S&P has made a new all-time high on a price ratio basis relative to the MSCI as of 2015. Now, one reason that's sort of supporting this is that despite what looks like slowing growth around the rest of the world, I actually think U.S. growth rates are about to pick up in 2019. Now, what gives us confidence that the PMIs in the U.S. are about to accelerate? On slide 23, you'll see two lines. The dark blue line is the U.S. ISM, or what we call the PMI. And the red line is the yield curve, but not the front end. It's actually the 30-year yield curve minus 10-year yield curve. I'm sorry, the 30-year interest rate minus 10-year, but it's the 200-day change. So it's how is the long-term yield curve moving? And I've actually moved it forward 16 months, meaning let's assume the yield curve is predicting future growth. What's happening in the future? Well, here's what's interesting. Since 2009, and we've published many reports, so our institutional clients are familiar with this chart, the red line has been telling us what will happen with the PMIs with a 16-month lead. What does that mean? Well, here's what's interesting. As you guys know, there's been sort of a big downturn in the PMIs this year. In fact, at the start of this year, we told our clients that we thought there was a good chance that the PMIs by the fall would be below 50. Why did we think that? Well, it turns out the long-term yield curve in the spring of last year was plunging. And if you advance that 16 months, it would have told us that by the fall this year, the PMIs would be below 50. So in fact, this yield curve has done a very good job of predicting where the PMIs will be. But take a look to the right side. That red line is now starting to soar and accelerate, and it's telling us that the PMI should be starting to turn up sometime late this year and into early next year, but also soar to new highs. So we think one of the things that's causing the U.S. to decouple is that the cyclical slowdown in the U.S. is really sort of at the tail end, and we're going to start to see an upturn in the PMIs later this year. And the reason for that is, of course, is many things. The global inventory correction is over. Oil prices have been stronger this year compared to last year. That's actually helping cyclical dynamics. And more importantly, we think that underlying U.S. demand remains healthy. So even though there's a confidence shock that's caused the stock market to fall and also really affecting some of these sentiment surveys, we think that as the shock fades, we're going to start to see a normalization. So we think the PMIs are going to turn up, and that's a decoupling taking place. On 24, there's a second reason we see the U.S. decoupling from the rest of the world, and it's because the U.S. stock market is just simply that much better. So what this chart shows is four countries: the U.S., Europe, Japan, and China. And we have little pie charts. Those slices are different sector weights for each of those countries. So for instance, the dark blue are the high value sectors, the high margin sectors, which are technology and healthcare. Those are really the two industries that generate not only high return, but have high intellectual property value. And the red slices tend to be the deepest cyclical industries, like industrials, energy, and basic materials. And then the light blue are sort of in between, discretionary financial. Well, as you can see in the U.S., 34% of the S&P's weight is high value sectors, and 16% are deep cyclical. What does that mean? Well, on the U.S., on a standalone basis, the U.S. is twice as exposed to high value industries, meaning when you buy the S&P, you're not really buying cyclicality, you're really buying intellectual property. Well, how does that compare to the rest of the world? Well, take a look at a country like China. Only 10% of its sector weight is high value, tech and healthcare, and 30% are deep cyclical. So it has twice the cyclicality and only 1/3 of the value add. So in other words, when you're buying China, you're buying the PMIs. How about Europe? Well, in Europe, deep cyclicality is 1/3 of their index. It's the same as China, and only 18% is value add. When you're buying Europe, you're just buying the PMIs again. Europe is not the same as the U.S. The U.S., you're buying a high intellectual property, high value, high margin index. When you're buying Europe, the Europe Stoxx 600, you're just buying a cyclical index, actually deep cyclical. And even Japan, which I think is a creator of a lot of high value intellectual property, only 1/5 of the topics is actually value added, and 1/3 of that index is deep cyclical. So again, the U.S. is just simply different. It's basically a intellectual property index. Now in slide 25, there's something even more explanatory for why the U.S. is pulling away from the rest of the world, which is population and demographics. So I've got a few numbers here, but I want to highlight the growth rates. Okay, so I've taken the U.S., Europe, Germany, China, Russia, Japan, and on the column towards the right, there's something that says population compound annual growth rate, CAGR, 2019 to 2039. And as you can see there, the U.S. is projected to have population growth. This is from the United Nations of 0.6% per year. Now that may not sound like a lot, but it sure is a lot when you look at Europe, which has a negative growth rate of -0.1, Germany, which is -0.1, Japan is -0.5, and China is 0.0. Now think about this for a second. The growth rate of the U.S. population in the next 20 years is projected to be positive. Every other country is negative, basically. Does it make any surprise to you why interest rates are negative around the rest of the world? I mean, if your population's shrinking, maybe you should have negative rates. Well, in any case, take a look at what it means on the right. We're going to say the absolute change in population over the next 20 years. See, here's where it's really interesting. The US is going to grow by 43 million people from a base of 329 million. So, more than 10% growth. Europe's going to shrink by 13 million. Germany's going to shrink by 1.2. Japan's going to shrink by 11 million. China's going to have no growth, and Russia's going to shrink by 7 million. So, without question, the population trends are in completely opposite directions. Okay, well, that ties to slide 26, which is, okay, well, let's move away from population. Let's think about, investment spending by country. So this chart shows you fixed investment as a percentage of GDP. Okay, and this is from the CIA World Factbook. The reason I think this chart is helpful is that it's a measure of the stage you are in a business cycle. Also, and it just shows you the level of capital investment. So today the U.S. is at 17.2%, which is this horizontal line. And it's a bit of an anomalous number because, as you can see, it's actually below Argentina, Venezuela, and Afghanistan. So we've got really low levels of investment in the U.S. And it's so low that not only is it below third world countries, but it's below Germany, EU, Japan, Korea, China. I mean, it's below basically most every country in the world. And that's what slide 27 shows. One of the reasons we think the U.S. is decoupling is that it's not really late in its business cycle. This is all private investment in the U.S. as a percentage of GDP. And at 24%, the U.S. Is well below that 27% number, which I've marked in red. Well, why does that 27% number matter? It turns out since 1970, the U.S. has never been mid-cycle in its expansion until this number hits 27%. So that number was tripped in 2005. It was tripped in 1997. It was triggered in the early 1980s. Basically, we've never seen an expansion since 1970 where this number has turned mid-cycle without hitting 27%. And in fact, on slide 28, if you look at the components of this, you can see the U.S. just isn't overspending on Capex right now. Capex is below long-term average. Non-residential investments below long-term average. Housing investments below long-term average. Consumer durables purchases below long-term average. The U.S. has been quite cautious of making long-term spending commitments, and I think that's why we're not late cycle. Okay, so now I want to jump ahead and turn to slide 33. Because there's something happening globally that over the next 10 years is going to strengthen this relative decoupling of the U.S. versus the rest of the world. And what is that? Well, it's global labor supply. The dark blue line is the 10-year rolling growth rate of the prime age workforce, and the bottom, the gray line, is the total growth rate of the population. Okay, so these are 10-year percentage growth rates. What it tells us is that when the blue line is above the gray line, the world is experiencing labor surplus. We started experiencing that labor surplus in 1973. That's what this bottom chart is showing. It's kind of highlighting the spread between the prime age workforce growth and the total population growth. And this period of surplus has continued from 1973 all the way through 2018. Well, a couple things that it tells us. Number one is during this period of time, the ratio of workers to total population, or let's just say ratio of workers to output, had risen by 27 percentage points, meaning that there were 611 million excess workers for each unit of GDP output, which means, hey, the world's been awash with cheap labor. But as you can see towards the right side of this chart, beginning in 2018, we've actually flipped. So the world no longer has excess labor supply. So we're actually ending a period that's lasted for 50 years of excess worker supply, and we're flipping. And why does this matter? Well, take a look at page 35. See, on slide 35, this surplus in workers was actually the reason for the boom in Asia. The first region to have excess surplus labor were the Asia Tigers, which is Korea, Taiwan, Hong Kong, etc., and Singapore. And you can see here that surge continued and actually began to sort of peak in the mid 90s. Well, beginning in the early 2000s, you can see China's labor surplus began to accelerate, and then that's kind of run out. And now there's only really two regions in the world that actually have some surplus in labor, which is India and Africa. And on the flip side, page 36, you can see that the developed world actually started to have labor shortages around this time. So Japan in 1998 went into structural shortage of workers. Europe, beginning in 2013, the U.S. started to have a deficit beginning in 2014. But as you can see, unlike the rest of the world, the U.S. shortage is actually going to eventually reverse, and that has to do with population growth. And even countries like Korea no longer have surplus labor. So the world in general, this narrative that you would have seen is Asia's had a surplus of labor, that period's ending, but at the same time, the developed world has actually been experiencing a greater and greater shortage of workers. Now, why does this matter? Well, it turns out when the world has labor shortage, but you actually have population growth, then automation is driven by necessity. So I think one of the things that when you think about the themes of the future and people talk about automation, automation's growing important, and it's not necessarily because you're trying to replace and put workers out of work. It's because the world just doesn't have enough labor supply relative to population growth. So automation's a necessity. Okay, so let's assume it's a necessity. Um, who's going to benefit? Well, keep in mind there's only three countries that supply automation. It's the U.S., it's China, and Japan. And over the next 30 years, do companies and countries want to be buying automation products from trusted entities? 100%. So that means that they're less likely to be buying Chinese automation products. One of the issues with Japan is of course the language. A lot of the programming language could be written in Japanese. So it does seem to benefit, in our view, the U.S. And in fact, in the past, whenever there's been labor shortage in the U.S., that's actually happened twice, as you can see on this chart. 1948 to 67, we had labor shortage, and 1991 to 99, U.S. had labor shortage. The bottom half of that chart is technology stocks to S&P. As you can see, tech stocks went parabolic every time we've had labor shortage. So to me, this is a really bullish signal for not only U.S. tech, but because U.S. tech is going to be the primary world supplier, it's really bullish for U.S. equities. And let me just jump into why then demographics and millennials are really the final piece of the U.S. Exceptionalism. So this is slide 40. This is the 6 living generations in the U.S. Everything from the greatest generation, they're the oldest generation. And what we've done is just taken the U.S. population and broke it up into roughly 20-year periods with these demarcations set by the Pew Research Center. And here's what's interesting. If you look at each of these 6 generations, their peak size is actually different. So I've listed the maximum size of each generation. As you can see, the boomers were quite large, Gen X is smaller, millennials are bigger. So each generation has roughly different numbers of people. And on the right side, I listed the year each generation peaked. And again, that kind of varies because it's a function of not only birth rates, but it's a function of immigration and death. And so the year that each generation peaked is different. Why does this matter? Well, if you look at page 41, it turns out that if you use demographics alone, you could have predicted every stock market top since 1900 within 1 year. So this chart shows you the Dow in the blue line And I've marked the peak of each generation with a vertical column. And as you can see, every generation's peak has coincided with a major market top. And that's 1930, 74, 99, and last year was the peak of Gen X, and we had a major global market drawdown. So why does this matter? Well, it tells us that because this drawdown is largely ending, we don't think that the S&P is going to peak until 2038. So in other words, I think 2019 was the start of a new bull market. Now, another way to think of the long-term outlook is slide 42. This chart is the S&P 500's 10-year rolling return. Okay, so it's the total percentage change on a rolling basis since the 1800s. And here's what's interesting. Stock market bottoms or generational bottoms have occurred when the rolling 10-year return falls to zero. That happened in 1897, 1939, September 74, and February 2009. And this is one of our favorite charts we used to use at JP Morgan. And that stock market peaks don't occur until rolling returns hit 500%, which happened in October 29, June 59, September 2000. And if we look to the right side of this chart, it tells us that if a new bull market is indeed still underway, that this S&P won't peak until roughly 2029 and potentially at around S&P 19,000 or some level around that. So that's what this chart shows. Now, this is a pretty aggressive forecast, right? Because this is saying that the S&P, which is at roughly 3,000 today, could in another decade be 6 times higher. Okay, so it sounds fantastically high, and it would require roughly 15% earnings growth, 12 to 15%, and then the PE to reach somewhere around 26 to 34 times, which, as you can see, with each of the prior peaks, that's roughly in the PE range. But here's where demographics make this interesting. This chart is combining two different data sets. The top chart is S&P rolling returns, the chart you just saw. Okay, you can see the same up and down. And the bottom chart is actually population growth. This is the 5-year change in the number of adults. And as you can see, these are pretty much in sync, that basically U.S. population trends have explained every stock market top. Again, it's really helping us triangulate the idea that population and demographics are key. And the reason for that is that as a generation ages, they start to spend differently. So as a population, as a person reaches their late 20s, they start to have more income, and they start to borrow more money and make major purchases. So I think that there's a reason why population demographics explain stock market movements. And if you look at page 47, I'm skipping a few slides here. As you can see here, this number of people is beginning to accelerate, and that has a lot to do with the millennials. So again, because we got this tailwind from millennials, and it's been known to be tied to spending levels, I think that's really part of our bullishness for the U.S. So let's turn and talk about investment strategies. Okay, and that's on page 51. So if you look at this year, there have really been 4 standout strategies that have worked for most of the year, and actually have been continuation trades since 2009. The first one is that the S&P has been beating the rest of the world, and we believe that's going to continue. The second is that the world has been favoring stocks that are asset light, and I think in a world of Fed cuts and falling interest rates, I still think that's a winning trade. The third winning trade that's been working this year has been large caps beating small caps. I really should sort of flip the chart around so you can see that. But I think that that's very structural, that markets are favoring liquidity. U.S. markets are deep and liquid, and they're buying the S&P 500. And then the chart on the right is showing you that U.S. cyclicals are beating global defensive. So I think that you still want to have a cyclical trade in place. And on 52, why do we think asset-light stocks do well in a falling interest rate world? It makes sense that as interest rates are falling, investors want to not be constrained by a company that has to buy a lot of assets because the returns aren't going to be as attractive. So it makes sense structurally for asset-light stocks to outperform um, in a falling rate world. And in fact, on page 53, if you were to look at U.S. corporations in general and say, are you spending, what is your fixed assets required to generate $1 million of EBITDA? Um, it peaked in 1985. So since 1985, U.S. companies have been using less assets to generate each dollar of EBITDA. And that, again, is consistent with the idea that the U.S. is trying to become asset light um, because in a falling rate environment, they want to de-emphasize being long assets and they want to be asset light. So where does that leave us on stock selection? Well, let's just jump to page 58. See, when you think about Fundstrat and what we do for our clients, we're not necessarily trying to find home runs for our clients. We're actually trying to find the best win rate or the best probability of success. So there's two basketball players here we're showing you. Shaquille O'Neal is one of the greatest players in basketball, and Rick Barry may not be as well known, but when it comes to free throws, okay, they have very different success rates. So Shaquille O'Neal, one of the best basketball players in history, has only a 52% success rate with his free throw, and that's because he's throwing his free throw traditionally, which is overhand, and that's about in line with what NBA players do for free throw. But on the right side, Rick Barry had an unconventional way of shooting his free throws, which is actually mechanically better, but he did it underhanded, but he made 90% of his shots. That's what Fundstrat is trying to do. We're not trying to find you a sexy stock portfolio. We want to find you stocks that have a high probability of winning, and that's why we have our process is known as granny shots. And so what we do is we take 6 thematic and tactical portfolios, and it's going to vary. So some years we'll have more, some will have less. But at the moment we're tracking 6. And then we're identifying stocks that fall within each of these portfolios. And the ones that are at the top of this list, okay, the number of layups becomes our granny shot. So as you can see, number 5, with the most overlap is Google. Number 4 is Apple. Number 3 are Facebook, Nike, Tesla, and Booking.com. And number 2. So this is really our approach, that we're trying to find clients using different thematic models, the highest probability of winning stocks. And as you can see, it's been helping clients this year. So year to date, our granny shots is beating the S&P by 320 basis points. Actually, if we take into account September, I think that it's now 400 basis points. And with the exception of May, which was a big drawdown month for the market and for the granny shot portfolio, you can see that granny shots have been delivering fairly steady returns relative to the S&P. So again, that's really our approach. We're trying to find high probability stocks that have a chance at beating the market. And this on slide 61 is our current list of granny shots. Now, if you want to know how that portfolio has changed over the course of this year, that's what slide 62 shows. So the left side is the granny shot portfolio as of January 10th. Okay, and then we rebalanced it in March, which was our 2Q19 rebalance, and we added Qualcomm, VR, eBay, Philip Morris, and we deleted Deere, and then we rebalanced again for the third quarter and added 4 stocks and deleted those. So as you can see, the chart on the right shows you the current granny shot constituent list. So again, it's a portfolio that we balance every 3 months. But again, it ties into all the things I've talked about, from everything from the robotics to the millennials to asset intensity to some seasonals, and we're trying to find the best ideas, and that's what comes together on this granny shot list. So I'm going to kind of conclude my prepared remarks here and turn it over back to Cynthia.
Okay. Well, thank you very much, Tom. And what I would like to do at this point is let everyone know if you've got any questions for our presenter today, to please go ahead and add those into the questions panel, and we will try and get to those questions in just a couple of moments. But I would like to take a moment here and show you where you can access FS Insights on the Interactive Broker platform. Notice here, first of all, I'm going to take you to the pricing menu where you'll find research and news. Now notice here that you'll find the information that is included, but I'm going to do a quick find on this page. Let's go ahead, which will take you right down to the FS Insights. Now notice here, I do want to point out there is a free monthly trial that's available, a free 30-day trial, I should say, if you do want to try out the features that you'll get access to by subscribing. Now notice here, there's a Learn More button that's included at the very bottom of the page that will give you the information as well as the ability to view any of your sample reports. Notice here you can actually drill right down and you'll see those reports are available in PDF format and will automatically launch so that you can access that information. Also do want to let you know that if you are interested in any of these items, let's see if we can I'm going to bring up that website once again, and let's see if I can move back. You'll see the information on how to subscribe is available here as well. So if you'd like some additional information, please check out these links, and you can check out that free 30-day trial period. So with that, I'd like to once again open this up to questions over on the right-hand side of your screen. And Tom, if you've had a chance to read through those questions, let's go ahead and see if we can handle some of them. I'll go ahead and pass you the controls back, or let's bring your screens back up. And if you can handle those questions, that'd be great. Thanks, Tom.
Okay, great. Thank you. Let's see. I'm gonna I gotta undock this pane here so I can sort of widen this here. But there are a number of questions here. Thank you for all your questions, by the way. And they're not just asking me what I'm wearing today. There's a few ones I'm going to answer pretty easily. The first one says, can we make the slides available after the call? And I think Cynthia's already answered that. Yes, we will make those available. There's a question here that asks, can you go over why the peak in Gen Xers will not lead to a bear market? Okay, so Nat, I'll answer that question. And I'm going to go back to the slides, okay, and try to, it would be, if you have the slides in front of you, it's actually on page 40. And the answer to the question is, we already had a bear market. You know, in 2018, and Deutsche Bank published a great analysis of this. The greatest number of risk markets had a decline in 2018 than any time in the last 120 years. So it was a historically bad year for global risk in 2018. So that, to me, is the bear market because of Gen X. Now, why wasn't it more severe? Well, on page 40, you can see part of the reason is Gen X is just a small generation. There's only 66 million in total, and the boomers were 80 million. So there's actually should be less of a drawdown, which is why I think that the 20% decline we had in 2018 was the bear market associated with Gen X. There's a question from Stan says, so could be a big drop to test down, then a quick run up. And the question is there a chance that we have a drawdown before we have a rally? And because it's October, yes, October's crash month. In fact, more stock market crashes have taken place in the month October than any month of the year. So there is a reason for people to worry, and there's tax loss selling. But I do think that we already had August volatility. I would probably be a contrarian. I think the market is poised to have a run that's really starting now into the end of the year. So I think that because of positioning and because of the levels of panic, I'm not sure we're going to get a drawdown in October. Um, there's a question. I'm kind of working backwards. If growth is set to accelerate in the U.S., does that mean a backtracking Fed and hikes down the road? And how would that affect our recommendations? I think the Fed. I think that's a good way to think of it. The question is really, is what's the Fed going to do if cyclical growth improves? I think the Fed, if cyclical growth doesn't improve right now, the Fed is way behind the curve, like by 75 basis points. If we're correct and cyclical growth is going to pick up, I think the Fed still needs to ease because the rest of the world is causing the rate structure in the U.S. to be funky and financial conditions are tight. But it's really bullish for the U.S. consumer because remember, if the Fed is keeping rates low and inflation is picking up, we're talking about more negative rates on a real basis in the U.S. And so I think we're in a sort of a weird world where the Fed has to be making dovish mistakes, but the mistake is to the benefit of equity. If there's a question, says if I'm an existing interactive broker customer sitting in cash, can you take it over and run a portfolio for me? The answer to that question is we do actually have an ETF that's designed to track. There's an ETF by direction that's designed to track our portfolio largely, and that ticker is DQML. So you can invest in that and get exposure to our strategies that way. There's a question says in a declining interest rate environment, wouldn't asset-heavy companies benefit from declining cost of debt? That's a great question, and that's how most people think of it. They say, okay, look, if rates are falling, shouldn't you be long assets because it's cheaper to buy it? But that's actually not how it works. When you borrow money to buy an asset, you're buying it with the expectation of inflation. Think about it this way. If you're about to buy a house, but someone told you, oh, the future price of the house is going to go down, you're not going to buy the house. You're going to wait. See, you only make a long-term purchase if you think it's going to go up in price. That's how businesses work. They purchase assets because those assets generate money. If they think the price of that asset is going to fall, instead of creating earnings that way, they're going to pursue asset-light businesses. So it's actually the opposite psychology, that you need a belief in inflation to cause Capex to go up. And that's why, in deflationary environments, no one spends money. And it's, Stan, just FYI, it's a DQML, like D like David, Q like Q-tip, M like Mary, L like Larry, DQML. Let's see. Andreas said loud and clear. I think that's a sound check. Kapil's question says, is on the one hand you say the sentiment's too bearish, on the other hand you point out the market keeps going up. Is there a disconnect in what people say and what they do? Bearish but do bullish. In which case could equities have already priced in bullishing? Very good question, Kapil. Here's my perspective. Consensus is right about half the time. But at the extreme, consensus is completely wrong. Think of it this way. I mean, Warren Buffett says it exactly. He says when the crowd is scared is when you should be buying, and when people are confident and bullish, that's when you should be selling. Because remember, at the extremes, people start to make mistakes. And so I think what we experienced in August was a consensus mania around a recession. I mean, Google search is going ballistic. And, even on national TV, like, Good Morning America had a segment on the inverted yield curve with Jim Cramer. I mean, tell me that's not crazy. That is an extreme sentiment move, and I think you have to buy that. SaaS stocks are crashing today. Any thoughts? I think software and cloud have been, really big winners for folks. Something to keep in mind is that as you get into the end of the year, some people may be trying to sort of do some portfolio balancing, and I'm not surprised you're going to see some profit taking on some of these big winners. And similarly, if there is a belief that cyclical growth is improving, you should see semis acting better, and in fact, that's kind of the case. So I think that people who are using growth as like their defensive positioning could be uh, shifting towards a more cyclical portfolio if in fact they're confident about markets rising. So I think it's, that's potentially a factor. Um, then there's a question says, thank you, and thank you guys for tuning in. I see a lot of thanks. There's a question says, what's your rough estimate if you adjust your demographics for women in the U.S. and world workforce after 1980? Again, that's a great question because what Alejandro is pointing out is that workforce participation has really been transformed because as women enter the workforce, they've supplied labor. That's a great question. Um, and I don't have an answer to that. But one thing I will point out is labor participation, which is really what you're pointing out, which is what I call the employed ratio to total population. That is a much better leading indicator of inflation than the unemployment rate. So I'm kind of indirectly answering your question, which is we actually track that ratio, employed to population, because I think that that perfectly explains wage inflation. And again, if you become an FS Insight customer, you'll see our future reports that where we discuss this, because we think it's going to tell us why there's an inflation pickup in 2020 in the U.S., which is again super cyclically bullish for U.S. There's a question here. It says, what are the implications of record income inequality impact on long-term demand? Does labor shortage help reestablish wage growth? Yes, I think that, Ted. So, Ted, your question is about labor, and I think that part of the reason there's been income disparity is the world had too many workers. So the people with capital said, hey, I'm just going to pay people a lot less because there's always some place to outsource. I mean, that's, 1997 thesis for globalization, and I think it did hurt the workers. But now the opposite's happening because, as you're pointing out, this is sort of like the bubonic plague. Um, sorry, during the bubonic plague, the workforce shrank because a lot of people died um, from plague death, and it caused massive wage inflation for the surviving workers. So labor shortage is going to favor middle class and laborers. So I think it's quite bullish for income inequality, actually. Um, there's a question from Lee asking, what's the so-called trade war effect have on your thesis? Do the dynamics you discussed trump it? Clever use of the word Trump. The trade war is a big deal. I mean, because on the one hand, I think the timing's actually quite good. I think that the trade war with China US is taking place at a time when China's structural advantage on labor. Remember, China had a huge, huge surplus workforce labor, so they pretty much could just say, bring your capital to China. We got cheap workers. We can build it. Now that's no longer true. There's a lot of wage inflation in China. And in fact, as many people have pointed out, the U.S. is less dependent on China for trade, but there have been a lot of trade injustices taking place, whether it's the sharing of intellectual property, the requirement of JVs, et cetera. So I, as strange as it sounds, I think that the trade war is probably coming at the right time, and I think the U.S. Is in a good position, but I don't think any side's going to win that war. So I think that whatever we see coming out of this trade tension is one where the U.S. Gets some of its demands met, but China is here to stay. So it's not like someone can cause China and trade war them or embargo them into oblivion. So the two only important economies in the world today are China and U.S. How do we know this? Well, we did a piece for our clients last week showing that take a look at aggregate wealth. China has $50 trillion of household wealth. The US has 100 trillion. That's 150 trillion combined. How big is that number? You have to go to like the next 60 countries, including Europe, Japan, basically the rest of the world, doesn't even equal that number. So, China and the U.S. are the only two economies that matter. And so they coexist with each other. So that's why I think haven't been turning too bearish on this trade war issue, because at the end of the day, it's just transfer payments between two people that coexist. But I do think that the current administration is correct in many of its arguments. What happens to the price of real estate, Paul? I'm glad you asked that, because it's a slide I skipped over. It's on page 49. Um, did you know that if we could turn to slide 49, did you know that real estate cycles have been pretty much explained by population? And uh, in fact, the only exception to this trend was actually the period from 2000 to 2008, because we had a big structural mismatch. And let's see if I can get to slide 48 for you. 49. But if I can't, it's on slide 49. But basically, because the millennials and Gen Z are going to start to cause an increase in the number of people aged 30 to 48, I'm very bullish on housing. So I think housing is going to be a great long-term trade. Let's see. What is your view of the dollar relative to other global currencies? Do you think the Toronto Stock Exchange is similar to the stocks? Um, Currencies are really difficult to project. So I don't have a view on USD, but I would say that um, I think the dollar is too strong. If the Fed's cutting rates, the dollar should be weaker. If we have if the Democrats take over in 2020, and they do MMT, dollar's going to be under pressure, and Trump doesn't want a strong dollar. I don't think the dollar necessarily should be strong. I don't know the TSX as well, but my guess is it's going to be a very cyclical index, because I think it's dominated by gold and energy, and cyclical producers, and not as much by tech and healthcare. There's a question about Bitcoin from Stan. Bitcoin's a good question. We've written about this, and we're about to write it this week for our clients, that Bitcoin doesn't do well if there's no macro trend. I think Bitcoin will know what to do if macro trends are positive, like in years like 2017 where everything went up, or 2016 everything went up, Bitcoin went up. But in years where when 2018 everything went down, Bitcoin actually lagged. I think 2019, the reason Bitcoin hasn't moved since for the past few months is that there's no macro trend in place. So I think until we see a breakout in the S&P, decisively telling us what we expect to be a cyclical acceleration, I think Bitcoin is in a holding pattern. And in fact, we track that through our Bitcoin Misery Index, the BMI, and actually we wrote in July 31. So about a month and a half ago, we told our clients that the Bitcoin Misery Index told us Bitcoin's going to be going nowhere for a while, and that's indeed been the case. So why is this not a bear trap, as the technical suggests, from Sid? Sid, not every technician is viewing this. Not every technician is actually bearish. I think there's a lot more technicians who might say that the market is not decisive, has not provided clear signal. So I think that there's a large pool of money that says there's no clear trend, and so they're going to wait and see. And I think that's why positioning is cautious. But I don't think that the technicals have necessarily turned negative. And let's see, could China experience unrest from low employment and lack of dollars? Yes. I think from Stan, the question about China is 100% true. Will that lead to revolution? I don't know, but as you know, the political power is a function of making sure they can keep constituents happy. So I think it's important that China can't necessarily, even if the country's committed, if there's a large loss of jobs and closures of businesses, support for a hard stance is going to fade. I said shortage of workers good for wage growth. but the U.S. will have a huge millennial population, which is bearish for growth. It's actually true, but it's not true. So the reason for that, um, Sharda, is going back to, again, it seems like the slides aren't working, but it's page 38, that because there's a lot of retiring boomers. See, so this chart is just plotting the U.S. population trend. Okay, so when the blue column, the little area chart, blue is above zero, there's labor shortage. Because there's so many boomers retiring, and Gen X isn't able to step in and, like, because it was a small generation, so you're relying on the millennials, which are much younger. You got a pretty sizable labor gap taking place that's going to run through 2030. So even though the millennials are actually bullish for a lot of other things, when in terms of total labor supply, it's actually still a shortage. And then the question is, what's my view on the cannabis sector? It looks like it's the last question. I think, one of the things, and I've been in research for over 25 years. So, and my first job in 1993 was actually covering the wireless industry. And even though people take for granted that everybody has a cell phone today, 1993, that was not how people viewed the world. There were only 34 million cell phones in the world in 1993, and a lot of people thought it was just a yuppie toy. So, only rich people could afford it. They didn't think that kids or poor people could own a cell phone. And it told me that people never understand the potential disruption that comes from things that can grow very quickly. And I think cannabis actually has a lot of potential, especially on the pharmaceutical side. So, I'm not as sort of optimistic about maybe cannabis as THC, and it could be good for mental health, but I think the pharmaceutical side, where it's related to CBD and other drugs extracted, is the real opportunity. And in fact, that's where the money will be made. I think the money that, if you look at every growth industry from internet to wireless to cloud, there's only two types of companies that really win. One is those that have network effect. And in cannabis, you can create the network because if you create some value-added product that people need, there's a network effect. But for anyone who's just producing this, they're not going to have the network effect. They're just a commodity supplier. And then the second type of winner are those that provide what we call middleware. Those that supply components that everyone has to use. So the tower industry, for instance, was the best industry to come out of wireless. That's a boring business. They don't do anything except they provide connectivity. So I think if you're going to invest in cannabis, look for those two types of companies. There's a question from Nat. It says, does the U.S. debt of 22 trillion give you any pause? Yes, it is. The U.S. has lost all fiscal responsibility. It's now balanced budgets or funding deficits. It's all become a farce. So I think that's one of the things that is quite alarming today. And it really does start to risk the credibility of markets. But keep in mind, we learned something in school, and I think it's still true today. When you guys took your first finance class or economics class, do you guys remember who wins in a world of inflation? The biggest beneficiary of inflation are debtors. So this is counterintuitive. People tell you that the U.S. government's addicted to low rates. Kind of, because debt service is actually really low today. So even though the U.S. has 22 trillion of debt, their interest payments on the debt are like the lowest they've ever been in history, or in modern history. So it's not costing us a lot of money. But the U.S. government would love inflation because tax receipts go up in inflation. So if I was a U.S. government, I'd be borrowing a lot of money right now and then praying for inflation. Raul Paul is bearish. I think the world is in bad shape, so I think it is correct to be bearish on the world, but one would have to believe the U.S. is decoupling. That's our view. So I think we're bullish on the U.S. But remember, the U.S. is like, U.S. and China are the only two economies that matter. If the U.S. does well, China's going to do better. So you might as well bet on the U.S. And then as the U.S. breaks out decisively, you can buy China and Europe because they're going to just be dragged along. So the question is, when's our prediction for the next recession? That's really easy. There's two things I'd say that will conclusively make us in the bearish recession camp. One is the 30-year minus 10-year yield curve inverting. So the long-term yield curve. We've written extensively about this for our FS Insight and our Fundstrat customers. The long-term yield curve has almost no correlation to what the Fed's doing. So it's pure signal, and that has also inverted the fewest amount of times in the last 50 years. So the 10-year, 2-year, 10-year, 3-month, those invert frequently because it's really about the Fed setting policy, but the long end operates on its own cadence. That's steep and steepening. So that's not telling us there's a recession. But the second thing that has almost always marked a recession top is private sector spending as a percentage of GDP reaching 27% and then exceeding that number. That's late cycle because that means businesses are overspending. But we're not, we're at 24% today. So I again, I don't know the future. The future is uncertain. But from our perspective, we're mid-cycle in the economy. Cynthia, I think that's the last question.
Well, Tom, thank you so much for being for today's presentation and for answering all of those questions. I do want to remind everyone we have been recording today's event, and each of you will get a direct link to today's recorded playback later on this afternoon. So if you do want to come back and review the concepts that Tom has gone over today, simply watch your email for a direct link. So with that, we are going to conclude our session. I also want to thank FS Insights for making today's presentation possible. And I don't want to leave the rest of you out as well. We do appreciate the time you've spent with us this afternoon. So with that, we are going to conclude our session here today. Thanks, everyone, for your participation, and have a great rest of your day. Watch your email for a follow-up that will come out shortly after today's session ends. Have a great rest of your day, everyone, and thanks.